Hello and welcome to Taking Stock. We are coming to you from the EBIX Cash Studios. I'm Prashant Nair. With me, my colleague Surabhi Upadhyay. It was a sea of red on Dalal Street with the Nifty and the Sensex seeing sharp cuts on Friday. For the week, both these indices ending over 3% lower. Nifty IT index was the only one to buck the trend and end in the green on Friday and for the week as well. All other sectoral indices down in the red. Surabhi, hi.
Hi, Prashant. Yes, absolutely. Quite a week and quite a day. I mean, Friday was an end in the red and deep in the red. We have lots to talk about as we get through the next half hour. Here's what the lineup on the show is looking like today. We will be joined by Andrew Holland of Avendus Alternate Strategies, as well as Jay Bala of Cash the Chaos. So we'll get you perspective and advice both on the fundamentals as well as technicals. We, of course, got a lot of market opinions through the course of the week, and you will hear out some of those voices. Shankar Sharma, Sanjay Mukim of JP Morgan, and Ramdeo Agarwal of Motilal Oswal Financial Services, to name a few. But before we get to all of that, let's just rewind the clock and see what happened. 5 trading days and largely cuts coming through at the end of it, between 3% to 4%, depending on which index you're looking at. So let's look at the tally first of all. For the week, the Nifty is down about 3%. Nifty Bank, as has been the case, has been falling a lot more. Mid-cap, small caps, nothing was spared in this market. It was classic risk off, and you could blame a lot of that onto the way the global picture is shaping up. That, by the way, is the FII picture for the month of December. We're again down to some of the highest levels of selling that we've seen in this calendar year, almost approaching 13,500 crores of selling in December, and the month is not even over. The previous high was in October, but remember, we still have another couple of sessions to go, and everyone's waiting for the foreign investors to perhaps get on their holiday so that selling abates. Very quickly, so what bothered the market this week? Two things. First, the reality that there is actually accelerated taper underway. The market didn't, in India and around the world, didn't exactly react immediately after the Fed announcement. The reaction perhaps, and that reality was sinking in, the reaction really played out on Friday. The other, of course, issue with the market is the Omicron spread. The headlines keep coming, and there is a lot of anxiety, perhaps, on the kind of economic disruption, the travel disruption that this is already beginning to throw up. So I guess, Prashant, putting some of these sort of points together, it proved to be pretty much a bear cocktail this week.
Well, that's well put, Surabhi. Bear cocktail. I mean, but just 2 points I want to make before I toss it to my colleague Sonal, who's standing by to run us through what happened in terms of stocks. The big worry for the market is this.
Numbers in front of you. For Q1, Accenture's revenues went up 27% at $15 billion. The EPS at $2.78 was up 20% year on year. Not just that, the new bookings came in at a record $16.8 billion, which is a 30% growth that we've seen in dollar terms. And the operating income grew as well. But more importantly, the company has raised their business outlook for FY22. They now expect the full year revenue growth of 19 to 22%, a handsome growth in FY22. Morgan Stanley says that it was a material beat on earnings and positive commentary on demand. Credit Suisse has put out a note where they say that the management sees a healthy pipeline in spite of record bookings, and 1/3 of the industry has now implemented a compressed transformation, and this is a strong multi-year cycle of growth. Infosys, TCS and HCL Tech are the preferred picks in the IT services space.
Sonia, thank you very much for that. Andrew, is that a space which could, COVID, no COVID, as we've seen earlier as well, play out well from here? We all seen the magnitude of Accenture's beat at that scale and size.
Yeah, no, I think even before Accenture came out with this, given the kind of difficulties we're seeing for markets, then it's always a place to hide IT, right? Because it's a defensive sector. It's been kind of not doing as well in the past few months, but I think that's kind of a more of a bounce from where we were. I think the tailwinds are there for the sector, digitization. Whether that's going to continue. That's great for the telecom industry as well. The metaverse, all of these things I think are playing into the technology sector and the IT sector going forward. So I think you will see more movement towards defensive sectors in the next few months if this continues. And I think the other thing about FIIs, which I know you've been mentioning there, is that two things. One, yes, they will take risk off the table because of higher interest rates globally. And don't forget, at some point, India with its current account deficit will also face those kind of higher borrowings as well. So that's something I think FIIs will be wary about. and the fact that China has, in terms of its regulatory problems, kind of slowed down a bit, and it's a much cheaper market than India. So I think we are seeing a shift from India to China and other emerging markets, which are looking cheap compared to where we are today.
Mm-hmm. Andrew, so finally, if indeed, as you predict, the first quarter of the new calendar, if it does bring lower levels, then apart from IT, what else would you go to in the market? What else would you pick? For instance, there's not such a huge run towards pharma this time around, even though we have, health worries, etc. So what would be the other go-to areas in the market?
So I think I would look at FMCG. I think that's the only other place I would probably want to hide in the very short term. So those two sectors, and selective pharma as well, because I don't think, again, that there are tailwinds for the pharma sector, which are multi-year, not just over a short period. So IT, FMCG, and selective pharma is where I'd be hiding.
Andrew, it's always a pleasure. Good hearing your views, and thanks very much for your time here on CNBC-TV18.
Thank you.
Thanks indeed. Well, we told you what's happened as far as the week is concerned with Sonal, but, what's the overall damage after the sell-off that we've seen? Mangalam is standing by to take stock. Mangalam.
Well, it has indeed been a market sell-off, in fact, not just globally, but locally as well because of those global factors. Let's talk about that. Let's map this decline. From the highs, the Nifty is down 9%. The Nifty Bank has fallen 15%. And we've seen a big decline in the mid-cap metals and PSU banks. The indices that were the stars of the first half of this year have also come off a fair bit from the highs. The three reasons for that. The first one, the constant pull-out of funds by the FIIs in the cash markets. October, November, December so far. Put all these numbers together, you have 90,000 crores pulled out of the Indian cash markets by the FIIs, and that's causing the pressure. The second pressure is that the global tap of liquidity that central banks had opened is now being tightened. The US Fed has announced a faster taper. The ECB has gone ahead and said that they will wind down their asset purchase program, and the Bank of England has actually gone ahead and raised their interest rates, the first that we've seen since the onset of the pandemic. And talking about the pandemic, that's not done yet as well, because UK had reported close to around 89,000 COVID cases in a day. That's the highest, and on a low base, even Mumbai and Delhi back home have actually seen the highest new COVID cases in a month. So all of that brought with it a fair amount of uncertainty, and uncertainty is not particularly good when the valuations are high. At the peak, the Nifty was trading at 22 times FY23 earnings, and even after this decline at 20 times, it is higher than its previous averages. What also did not do well is that towards the end of this year, with the gains that we've seen already, there was a fair amount of profits to be taken home as well. So profit booking exacerbated that fall. Even if you account for the decline that we've seen on the market so far, the Nifty is still up 22% this year. The Nifty Bank, which has been an underperformer, is still up 15% this year. And the mid-cap index is up 45%. A lot of stocks are sitting on huge gains. So maybe case for some profit taking, and that's causing the markets to sell off.
All right, Mangalam, thanks very much for all of that data and the analysis there. We will take a break on that note. On the other side, we talk technicals. Jay Bala of Cash the Chaos joins in to put this fall in perspective.